Hello, investors and traders. As you know, the goal of this YouTube channel is to help you develop your own investing or trading system. We follow over 100 indicators to increase our probability of success in the stock market. This channel not only provides you with these indicators and insights into market psychology, but also our recommendations on the overall market, sectors, and individual securities. In this video, we're continuing the series covering various indicators. Today's focus is video 3, indicator 3, the MACD indicator. One indicator alone doesn't create a system, and that's especially true for the MACD, which on its own has a poor success rate. If you just use the MACD alone, you will fail inside your trading or investing. However, I've identified scenarios where a MACD has a high probability of success. We'll cover high probability trading and investing strategies using MACD. We'll explain the basics of the MACD indicator and how to combine this technical tool with other indicators to build a strong investment strategy. The moving average convergence divergence MACD is a trend following momentum indicator that shows the relationship between two moving averages. To use MACD effectively, you must understand its definition, parameters, and key takeaways. Key points to success. MACD is more of an oscillator identifying key turning points. MACD will be triggered when you have 1 to 2 days of the market turning the opposite direction it was going in. This is very good in overall macro changes, coupled with other indicators. It's excellent at high and low points, helping identify significant trend changes. It is not effective in narrow ranges. It struggles when the market is moving sideways or there is a secular bear market or bull market. The trick is to combine the MACD with other indicators for better results. For example, using a MACD crossover along with an RSI below 30 can give you a reliable entry and exit strategy. This is very basic, but it's the start of how you should use the MACD. Future market growth should be evaluated with additional indicators. A picture is worth 1,000 words. And let's look at the 4 key points to success during COVID 2019 Q4 into Q1 2020 and setting off Q2 2022 just by using the key points to success. We said MACD is more of an oscillator identifying key turning points. So the MACD would be set off by 2 down days, which thus started a key trending for about 2 months. And then another key turning point is the MACD around March to set off a MACD buy signal. We said that this was excellent at high points and low points. We also said it is not effective in narrow ranges. So when the bull market took off, buy, sell, MACD, buy, sell, MACD, buy, sell, MACD, it was ineffective. We also said if you combine other MACD indicators. So at the top of the MACD sell signal, if you look at other indicators, let's say RSI, VIX, VXN, RIDEX ratio, call put, and combine them with a high MACD sell point or a low buy signal, it has a high probability of success. Remember also, during a bull market, MACD buy signals are better. During a bear market, MACD sell signals work better. So in a bull market, I would not be using the MACD sell signals, but I would be using the MACD buy signals. As you can see by this picture, and during the 2020 COVID days, the MACD sell signal and the MACD buy signal at the initial high and low points charts worked very well. Before you start using the MACD as an indicator, it's essential to understand its basics. What is the MACD? MACD stands for Moving Average Convergence Divergence. It is a popular indicator trading and investment using technical analysis developed by Gerald Appeal in the late 1970s. The MACD helps reveal changes in the strength, direction, momentum, and duration of a trend in stock prices. The MACD indicator or oscillator consists of all three key components calculated from historical price data, usually the closing price. These components are MACD series proper. This is a difference between a fast, short period exponential moving average EMA and a slow, longer period EMA of the price series. Signal or average series. The signal line is an EMA of the MACD series itself. Divergence series. This is the difference between the MACD series proper and the signal line. The MACD typically depends on three time parameters represented as a MACD ABC, where the MACD series is the difference between EMAs of periods A and B, and the signal line is an EMA of the MACD series with period C. The most common default settings are MACD 12, 26, and 9. 12 represents 2 weeks of data. 26 represents roughly 1 month. 9 represents 1.5 weeks. As with most technical indicators, the MACD traditionally derived its settings from daily charts when markets followed a 6-day trading week. Today, with a 5-day trading week, adjusting the parameters for different scenarios may yield better results, though it's always advisable to use MACD alongside other indicators for more reliable signals.
Now we learned about the MACD, but the real question is, how do we use the MACD indicator to profit in the stock market? As the market moves around, the MACD line will oscillate with ups and downs of the market. Then we have a second line that gets plotted, which is the moving average to smooth out that line and give us some signals. The crossover would be a buy or sell signals. You are looking for a crossing point of the MACD with its actual trigger line. When the MACD crosses down below its trigger line, that is considered to point where the indicator is considered overbought and could possibly indicate a short position, or you could sell your current position. Vice versa, if the indicator crosses above its trigger line, this is a point where it could be a turning point to the upside where you could possibly buy and go long. As you see, MACD buy signals and MACD sell signals. A lot of traders only use the MACD for reversals, and especially for major reversals, again coupled with 3 to 4 indicators. I have seen the MACD alone has not given good results. The MACD coupled with other indicators gives good results. Most individual indicators, including the MACD on its own, is just not enough for effective trading, but it is part of an overall set of tools and a process. Some examples of combinations are MACD with RSI, Relative Strength Index, CCI, Commodity Channel Index, and ADX, Average Directional Index, even combining 4 indicators to give you a clear picture of what's going on.
How traders use MACD. Traders use the MACD to determine trend direction and spot potential reversals. It's often used to confirm trades when paired with other strategies, but also provides its own buy-sell signals. The MACD is composed of 2 lines. The MACD line faster, the signal line slower, being a moving average of the MACD line. The MACD histogram, which oscillates above and below zero, reflects the difference between these 2 lines, indicating momentum and direction over a short term. Because the MACD is based on moving averages, it's a lagging indicator, meaning it's following trends rather than predicts them. It works best for stocks that are trending rather than those trading within a narrow range or showing unpredictable price action. In summary, while MACD is a powerful tool for identifying trends and momentum, it is not sufficient on its own. Combining it with other indicators and adjusting its parameters for your specific trading scenario can lead to better outcomes. Key takeaways. Moving average, convergent, divergent, MACD is calculated by subtracting the 26-period exponential moving average, EMA, from the 12-period EMA. Adjusting these values may yield better results in different market conditions. MACD triggers technical signals when it crosses above the signal line buy or below it sell. The speed of the MACD crossovers is often interpreted as a signal of whether the market is overbought or oversold. MACD helps investors gauge whether bullish or bearish momentum is strengthening or weakening in price movements. MACD is a lagging indicator and should not be used alone. Combining MACD with other indicators and using stop losses can lead to better results. Up to now, we learned about the MACD, but the real question is how to use the MACD indicator to profit in the stock market. Watch for crossovers. Bullish crossover. This occurs when the MACD line crosses above the signal line, indicating a potential upward momentum. Traders may use this as a signal to buy. Bearish crossover. This happens when the MACD line crosses below the signal line, indicating the potential downward momentum. Traders may use this as a signal to sell or short. Spot divergences. Divergences between the MACD and the price action can indicate potential reversal. If the price makes higher highs while the MACD makes lower highs, bearish divergence, it could signal a possible downtrend. Conversely, if the price makes lower lows while the MACD makes higher lows, bullish divergence, it could signal a potential upward reversal. Overbought and oversold levels. The space or the difference between these two lines will expand when the market becomes overbought or oversold. As the line tightens, it signals potential overbought on an oversold level, helping identify such signals. The MACD is a popular indicator in technical analysis that has stood the test of time. It is easy to understand and apply to any market or time frame. This tool measures a stock's momentum and can help investors spot change in market sentiment. There are many interpretations on how to use the MACD. Many systems and software are based on tweaks to the MACD. It can also spot trend reversals by identifying divergences in momentum. Learning to recognize and implement MACD signals will aid you in your investment plan. Remember, one indicator does not make a system. If you find this video helpful, please follow Insight of Investing. Good luck on your journey. You know the catchphrase. Study it, analyze it, adapt it. Peace.